Hi, I'm Jack and I'm an advisor at The Mortgage Hut. We get lots of questions about credit scores, so this video explains how your credit score works, what you can do to improve it to get a mortgage, and how you can get mistakes removed from your report. Even if your score is low now, you could boost it over time to access better interest rates, making your mortgage cheaper overall. One of the most common mortgage myths we hear is that there is a minimum credit score needed to get a mortgage. Put simply, that isn't true. Your credit score can certainly impact your choice of lenders, as banks use it to get a better understanding of your financial history and the likelihood of you defaulting on your loan. Usually, a higher score suggests that you're more likely to be a responsible borrower and make your payments on time and in full. However, every lender has different rules which affect what they define as a low credit score or a bad credit, and other factors such as your income and age can affect a lender's decision too. UK mortgage lenders tend to use 4 credit reference agencies: Experian, Equifax, ClearScore and Check My File. If you've ever checked your credit score before, you may already know that each of these agencies and that many others that provide information about your credit history use different scoring systems. This can be frustrating because one lender may refer to Experian and use their scoring system, whereas another may use data from ClearScore. Always check your eligibility before applying for a line of credit to avoid damaging your credit report. Lenders can see your previous loan applications when accessing your credit report, and a recent rejection for credit can hinder your ability to get approved for a future loan. Credit reference agencies obtain information from you from various different sources and in general keep the following information: the electoral roll, this shows how long you've been registered to vote at your given address; public records, this shows any county court judgments, bankruptcies, IVAs, debt relief orders and administration orders; account information, this shows the financial status of your existing, how much you've borrowed and whether or not you've paid on time; home repossessions, this is information from members of the Council of Mortgage Lenders about homes that have been repossessed; associated financial partners, this shows you all of the people that you are financially connected to; previous searches, this shows companies and organisations who you have looked at in the last 12 months. If you made an application for credit in the last 12 months, it would show here. Not necessarily. While having a low credit score can look bad from a lender's point of view, it doesn't give an accurate reflection of your circumstances as a whole. When a mortgage lender is deciding whether you meet their criteria for a loan, they will look at all the factors that affect affordability. Your income plays a big part in this, as the amount you earn impacts your ability to repay your mortgage. Lenders will look at the amount you earn against your outgoings, which may include debt repayments, bills, car insurance or travel expenses. If your current income could comfortably cover your current outgoings, as well as your new mortgage repayments and any associated costs, a lender may decide to approve you. Having a lower income that may not stretch to cover the above may cause concerns for some lenders, especially if you already have a low credit score. Your broker can take the time to listen to what you need from your mortgage and can calculate the most affordable route, whether your credit score is low, fair, good or excellent. The amount of deposit you need to get a mortgage will vary depending on a whole host of factors, including your age, the type of property you want to buy and your credit score. Most lenders require a minimum deposit of 5%, although an applicant with poor credit and low affordability may need to save a higher deposit between 10 and 15% to improve their affordability and choice of lenders. It can be reassuring to know that having a low credit score doesn't rule out the possibility of a mortgage, especially if you have the help of a mortgage broker, as they can quickly show you where the lenders are that may be able to offer you the finance you need. In short, even with severe and recent issues on your report that have resulted in a low credit score, it may still be possible to obtain a mortgage. Make all of your credit card payments on time. This will avoid any late marks on your credit report and impact. Don't make any applications for credit within 12 months of a mortgage application. These are recorded as hard searches, where too many of these look like you're relying too much on credit, which can impact your overall score. Stay out of your overdraft and ensure your credit card utilisation is low. Aim for keeping your balances below 25%, as this can help your score and gives the impression that you're in control of your spending. Check your credit report regularly to stay on top of your borrowing and get a clear overview of your debts and credit score. If you think that the information on your credit report is wrong, you have the right to dispute it with the company that has registered the error. This can sometimes be a tedious process, but errors on credit reports can delay mortgage applications and can exclude you from the access to the best rates. Getting declined for a mortgage is not the end of the road, and it's possible that there may be an alternative option elsewhere. We've helped lots of people who have been declined in the past, and our advisors can check your eligibility to avoid impacting your credit score further. They can also give you the advice to help build your score and prepare your application so that you're in the best position to successfully gain approval. Contact a low credit score expert on the phone at 02380 980 304 or use the Mortgage Hut's online form to let us know about your plans to get a mortgage.